Hi, everybody. Welcome back to the Discovering Multifamily podcast. I'm your host, Anthony Scandariato with Red Knight Properties, and welcome back. We have a great show here today. We have a very good guest, talks about a pretty interesting topic, Jack Krupey, and we're going to talk about what's a funds of funds. That's what the topic's going to be focused around. But Jack is a experienced real estate executive. Focused on investment and asset management, particularly now in mostly multifamily properties. And I'll let Jack kind of speak for himself, but he's advising passive investors today on, real estate and alternatives from select operating partners, and we'll explain what an operating partner is. Again, he's got a lot of experience. He knows what to look for when he's vetting real estate partnerships and sponsors, not only multifamily, but he's got experience in self-storage, mobile homes, and even the private lending space. So Jack, thank you so much for coming on the show.
Thanks for having me.
Good. So can you talk to us about your JKAM Investments platform?
Sure. So I had a career in private equity in New York. Since the 2008 financial crisis, we were actually buying distressed loans all over the country. So over the last 10 years, we underwritten over 30,000 loans, a lot of residential. So frankly, the multifamily almost seems easier because we get these like well put together packages from professional firms like yours versus prior we're looking for houses where you have a drive-by broker's price opinion and maybe you can't see the back of the roof that may not exist. So while I was doing that, I was living in New York, paying the highest, high tax bracket and, looking for alternative assets. So, I had to make the decision on, was I investing in a property in South Carolina or property in Georgia? And, I had a little bit of savings, but it wasn't like I had enough money to pick and choose and get the diversity I was looking for. So I left that firm last year and established my own fund. It's a Reg D 506C. And what I wanted to do is give friends, family, clients of mine the opportunity to invest alongside me, but also to have the diversity. Because the average accredited investor that is looking for exposure to the multifamily asset class generally has to choose. They might know a guy from a country club, they may know you guys, but a lot of them don't have the contacts or connections, and I want to make that more available to the community of accredited investors. And also there's a lot of synergies on the sponsor and developer side. As you know, it's very competitive and very hard to find good deals. And what I didn't want to be doing is competing and having to fight to win the 100-unit building where there's multiple offers. And what I found is a lot of operators, even great ones that have large client bases, when you have 30 days or 45 days to raise a few $1 million for a building, I found it's very, very synergistic to work with a group like mine that can aggregate a number of investors in and make larger checks for these projects.
Awesome. So can you talk about a couple of those projects in very high level detail, and also just explain to our audience why your method is beneficial for an operator a little bit more in depth? I mean, from my perspective, you're right. Usually it's 30 to 45 days, with fundraising, depending upon how long your contract is. And that could be very stressful for an operator, especially if it's in the tens of millions of dollars, even for, especially for emerging sponsors and operators. So, and what I mean by that, just for our audience, is just, real estate operators like my company, as an example, we aggregate capital, we pull financial resources from groups, and we invest it, in the real estate projects together that we're sourcing. So that could be stressful. So I think the fund of funds method is, I think, an emerging topic, because why don't you want to be an operator? Why don't you want to do what my company, Red Knight Properties, does?
Sure. That's something I've put a lot of thought into over recent years. And I think one thing is, just knowing sort of my personality and the type of business and type of skill set that I have. I've always been a connector. I've always been sort of an evangelist for real estate. When I was in my early 20s, I was the guy saying, buy a 2-family house, rent the other side out, live for close to free. I was very early in the non-performing distressed loan space after 2008. So, at the time, you also then had a lot of landlords who couldn't buy properties at the sheriff's sale anymore because Blackstone and Colony were going into the market. And, it's a natural progression for me to really, use my own capital, which is also co-investing in these deals, and help my tribe, if you will, my contact base to diversify their assets. Those who know me know I'm not a guy who's swinging a hammer. I know enough about construction to underwrite deals from all the underwriting, but it's really more of a wealth management play at this point to help my network find the diversification. And I really think the diversification is key. And you guys are a great operator, but at the same time, if you want a project in North Carolina and there's a hurricane that comes up every 5 or 10 years, or Florida. One project could have some challenges, but then now you have projects in Texas and Phoenix and other markets that are not challenged. So I think this asset class, which, the one downside is there's a little bit of a lack of liquidity compared to buying a REIT. That's more than offset by having the diversification and also the incredible tax savings. I also, I took it a step further. I actually moved to Puerto Rico. So I took advantage of the Act 20 and 22 tax benefits. Which if you are a bona fide resident in Puerto Rico, you don't pay any capital gains tax on Puerto Rico sourced income. And there's also a 4% tax rate for expert services, which includes management fees. So, I'm a bit of a tax nerd, and I enjoy helping, my friends and clients, make the most efficient investing decisions. And the depreciation that passes through on these assets is incredible. And I've really enjoyed, helping. And I'm not a CPA. I know enough about taxes to be, to be effective. But I can't give tax advice. But I do love walking people through the depreciation, and especially the accelerated depreciation that passes through on a majority of these projects.
For sure. And accelerated meaning bonus, right?
Yeah, exactly. Through the cost segregation study, it's pretty incredible. I assume you guys do that on many of your deals too.
And the reason why I bring that up is just because I've heard the same comments from our investors that, wow, this bonus depreciation is amazing. So you basically, some people, with the tax savings that they got and the actual investment that they put in, some people basically take it as a write-off. But again, I'm not a tax person either. There's a difference between passive losses and active losses. So definitely consult a CPA before even considering cost segregation. But obviously, the many benefits that you just talked about are the many reasons why we invest in multifamily real estate. So can you talk a little bit about more the fund of funds method, how it works? Obviously, you're aggregating capital from your network, and then you're aligning with operators, whether it's myself or somebody else, to partner together and find good opportunities. So how do you vet the sponsors, number one? And number two, from your background, how do you get comfortable with it being a good opportunity? Because it really comes down to the team and the deal at the end of the day.
Exactly. You said it right. So, the good news is I've been investing myself for a number of years, even when I was still had a full-time job in New York in private equity. So, these initial deals, many of the sponsors I've known for a number of years already. Whether it's myself or one of my other seed investors in the fund has been in real estate 30 years, very active in some of the more national mastermind groups. So there's a number of very well vetted sponsors that myself or colleagues have had money with for a number of years. So and over time, we're gonna be expanding the network. So it comes down to a little bit of an art and a science. Certainly looking at track record, having a personal referral. Having someone who's had enough experience that they've maybe been through the prior downturn and know that things don't always go up and sometimes there's challenges. Because I do think the last 5 or 7 years, as cap rates have compressed and the market's appreciated, was probably towards the easier end of the cycle to make money. And and on the buy side, the projects have to make sense. In an era where it's very competitive, we like to see projects that have a slightly higher cash on cash return that are approaching the 8 to 10% range, where the sponsor is not stretching to get the deal done. And there's little intricacies. We turned down a deal because we didn't like the siding. We thought that the sponsor was underestimating the cost of repairs for the shingle siding that was on the project. So there's little intricacies here and there. We're a big fan of Class B. Where we are in this economic cycle, I feel like it's a very defensive play. And there's enough quality Class B properties, whether it's B- to B+ or B+ maybe to even an A. We like that asset class, the workforce housing aspect of it. I feel like even if there is a little bit of an economic slowdown, we feel that people downsize from a Class A to a Class B. Right now, the single family housing market is on fire, and it's hard to find a single family house, and that's going to trickle down to apartment occupancy. And it goes back to the diversification as well. So good sponsors, good projects, and diversification, and we feel pretty good about providing a strong risk return.
Sure. So we talk about the asset class. How about the markets? What markets are you targeting? What do you see being hot? Obviously, you talked about single family housing there's like record sales and probably all across the country. Outside of the major metropolitan cities. Do you see that trend continuing?
Yeah, absolutely. And we're targeting the growth markets. We're in the Southeast. We have a deal in Augusta, Georgia, Jacksonville, Florida. We have a new deal we're funding next week in Lawrenceville, Georgia, and then we also have an asset in Phoenix. So we also we like Denver. We like Colorado Springs, Boise, Idaho. Really all the growth markets. And otherwise, we're somewhat agnostic. We would lean towards maybe a more of a secondary or tertiary market than a primary market. I'd rather take a 6.5 cap in Augusta, Georgia, or Jacksonville than pay a 5.5 cap in Tampa for the most part. But every deal is deal dependent. It really depends on how much of a value add component there is, and if it's the prototypical value add where the prior owner just didn't renovate the apartments for 15 years and just threw some paint on it and kept the rents low, versus the more aggressive value add where you're either building a new building or adding significant amenities or stretching, if you will. So, I think part of the focusing on growth markets will help as well. I mean, there's a natural trend of the population to move to the Southeast that was happening pre-COVID. I think I'm not saying people aren't going to go back to offices, but maybe 10 to 20% of people are now have a more flexible work-life balance where they'll be able to work from a cheaper area and maybe commute in 3 days a week as opposed to 5, or work from home and come in for meetings once a month versus having to be within a 30-minute commuting distance of their job. And I think that dynamic is probably changed permanently. With that said, people will go back to offices. I know some people are craving that, just the water cooler interactions, and there is some people are more productive with a 2-hour less commute, but there is a lot of productivity that comes from the office. So I do think that will bounce back to some extent.
That makes a lot of sense. And so are you focusing, with that being said, is it more what type of vintage are you looking at? What type of construction? And you mentioned you're vetting a sponsor's deal and they underestimated their siding. You mentioned Class B. So by Class B, is it 1980s properties plus?
Yeah, they've ranged from the 70s to 80s. Obviously anything built after 1978 or 9, you don't have to worry about lead paint. However, I feel at this stage, any strong operator with a strong property manager there's a system for handling those, the potential issues with lead, and frankly, some of the grants, some of the Fannie Green program for, replacing the windows anyway. I think some of that just gets handled naturally. So, it tends to be 70s to mid 80s. The Holy Grail is just the family-owned complex that wasn't very well aggressively managed, where there's a lot of embedded upside. And I did forget to touch on, when I kind of went on a tangent before, you'd asked about sort of how we work with the sponsors. So
yes.
let me just go back to that.
Just going to come back to
briefly. That. So we look at ourselves at, our sponsors are our business partners. With that said, we look for deals where we can aggregate a significant enough capital that it makes a difference for the sponsor. If you're somebody who's got, hundreds of thousands of downloads a month and basically you throw an email out and you raise more money than you need, we're probably not moving the needle. But for the sponsors that are, even sometimes better operators than marketers, we like to be able to plug in as sort of an outsourced partner that can move the needle and help them be more confident, even sometimes more confident in bidding, knowing that perhaps the first $1 million is spoken for. And for that, we also seek to get, when we move the needle, better terms. In some cases, we've got a higher preferred return because we're coming in with more money. Many of the sponsors set their docs up that way anyway, where, if you're over a couple 100,000, you get a higher pref. In some cases, we also, have gotten a piece of the general partner, which actually is rebated to the fund. So that means, what I strive for is if somebody's going to put 50,000 with me versus 50,000 directly into a deal, that they're getting better terms, and it does offset some of our management fee. To some extent, there is still 2 fees, but if that project does really well and we're getting a piece of the GP side, it's not out of the question that they actually make better money coming in with us. And then they're also getting the diversity, our network of operators and sponsors, and just our overall management insight. And I think there's value there, especially for the small investors that need diversification. What we've done, what we will do in some cases for much larger investors, if you're a family office and you have millions of dollars, many of them are probably not going to go into a fund of funds because they have an in-house team of people vetting deals. But at the same time, we have a deal right now where we're potentially directing a 1031 into a deal directly. So we have the consulting and advisory side where we might put 500,000 from our fund into the deal, but I'm also directing a $1 million 1031 through a tenant in common. So we really take a consulting advisory approach. It's real estate's a team sport, and especially given this time frames here, it's about who has the right amount of capital to deploy at the right time, and/or the right contacts that will come along due to our reputation, and where we can provide value to them in sourcing a quality opportunity that we'll put our own money into, and then help them find their 1031 exchange. Because that timing is very specific as well, as you know.
Excellent. Awesome, Jack. So how can people find you, learn more about you? Maybe they want to invest with you. How do they reach out?
Absolutely. So the website is JKAM Investments. That's JKAM Investments.com. We're on Facebook, we're on LinkedIn, and we're fully accessible. I'm looking to network with both sponsors like yourselves and investors. And at this stage is, every conversation is a good conversation if there's potential synergies. So I'd encourage people to reach out on all platforms. I assume we can put the links in the show notes as well.
Yes, I can, and I will. I'll have a link to Jack's website as well as LinkedIn, Facebook, etc. in the show notes on the iTunes description. So definitely check out Jack's platform. Very interesting stuff there. And Jack, want to thank you again. Hopefully I'll have you on again in a couple months or so and see how things are going.
Yeah, we'd love it. Always great to catch up.
Thank you, Jack.
Thanks. Have a great day.